Good day, ladies and gentlemen, and welcome to the session on changes in legislation for 2016. I am Yvonne Rousseau, and I will be your presenter for the next 4 hours. In terms of timing, we're going to have our first session for about an hour and 40 minutes, after which we're going to have a 20-minute break, and then we're going to have the last session of 2 hours. Please note that we are looking at changes in legislation and legislative updates that happen during the year. But that being said, we cannot for most of these acts only look at the updates and changes in isolation, as it will not make any sense. So you will see that we are going through a lot of detail in terms of the act as well, and not only looking at updates and changes. The very first act that we are going to look at, or set of acts, is the money laundering regulations in South Africa and the money laundering legislation. In terms of the money laundering legislation in South Africa, we have 4 acts governing our money laundering legislation. Just to give you a bit of an overview of all of these acts, first you have the Prevention of Organised Crime Act, or POCA, and POCA defines a money laundering activity. Then you have FICA, the Financial Intelligence Center Act, and FICA places a responsibility on businesses to report any money laundering activities. Then you have POCTATARA, the Protection of the Constitutional Democracy Against Terrorist and Related Activities. And we're not going to look at the entire POCTATARA Act, we're only going to look at the reporting part that it created in terms of FICA. Lastly, you have PRECA, the Prevention and Combating of Corrupt Activities Act, which talks about bribery, extortion and fraud, and the fact that that should also be reported. The changes we are going to look at in terms of these money laundering regulations is the impact of the new Financial Intelligence Center Bill and the impact that it will have on the money laundering legislation. That bill was tabled at the beginning of June 2016, and it will bring certain changes into the money laundering arena, and we are going to look at those in detail. Let's first look at a bit of background. What is money laundering? Now, money laundering is called exactly that because it perfectly describes what takes place. It is where illegal or dirty money is put through a cycle of transactions or washed, so to speak, so that it comes out at the other end as legal or clean money. So criminals will take this money that they obtained from illegal sources, these illegal funds, and put them through a succession of transfers and deals in order to make them appear as legitimate income, to come back as a legitimate revenue stream or salary for employment or sale of a legitimate asset. Important thing to know about money laundering is that it is not about cash. It is about the proceeds of crime. So a lot of people will say, in my business, I do not deal with cash, so money laundering is not an issue. Please note that that is absolutely inaccurate. Money laundering is about any proceed of any crime and not only about cash. So let's quickly look at the definitions, because it's important to understand the definition of money laundering in terms of our POCA Act, to understand when are you committing money laundering. So we have a few definitions in terms of POCA that we need to look at. The first one is the proceed of an unlawful activity. Now, to understand the proceed of an unlawful activity, we first need to understand what does an unlawful activity itself mean. And POCA says that it's any conduct which constitutes a crime or which contravenes any law. So it's literally anything that you are going to do that's against any law. Proceeds include property, money, movable, immovable, corporeal and incorporeal property. And then if you look at proceed of an unlawful activity, then will mean any property, any service, advantage, benefit or reward which you derived or received as a result of an unlawful act. So to summarize, any unlawful activity for which you receive a benefit or a reward. So what will then constitute a money laundering offense? Well, that's if you know, or you should reasonably have known, that property or this reward or this benefit is a proceed of unlawful activity. So you know that this reward or benefit that this person has, he got from an unlawful activity, and you still enter into an agreement or an arrangement with that person to either conceal or disguise the nature, source, location, disposition, or movement of that property, to enable or assist that person to avoid prosecution, or to render assistance to him to control that proceeds. So if you in any way advise, assist, or guide him to help him to hide that proceeds, to help him to not be prosecuted, or to help him to control that proceeds, you are committing money laundering. The definition itself is really quite wide. It includes a lot. Just to give you a little bit of an example, if you are doing a tax return for someone and you know that they are not showing all their income on the tax return, and you still submit that tax return as is to SARS, as if it is complete, as if it is correct, that person will receive a benefit. He will pay less tax. You are assisting him to do so. You are committing money laundering. Now, you saw the definition said if you knew or ought reasonably to have known. What does that mean? What does it mean to have knowledge? Well, the Act then goes on to say a person had knowledge if he actually knew, or the court is satisfied that he believed that there was a reasonable possibility of the existence of that fact. He had a suspicion and he turned a blind eye. You had a strong suspicion and nevertheless proceeded with a transaction without asking questions, without making inquiries, without making sure whether this is a money laundering offense or not. You will then be guilty of money laundering. They will prove that you had an element of knowledge. How will they prove this? In court, how will they do this? Because of course they can't just ask you. If they ask you, did you know? You will say, no, I did not. You can plead ignorance. So they won't ask you. What they do is they call it the reasonable man test. They get another person, a reasonable, diligent, and vigilant person, having both the knowledge, skills, training, and experience that is expected of you in your position, and the knowledge, skills, training, and experience that you actually have. And they give that person the same set of information. And they ask him, would he have realized that it is a money laundering transaction? And if that reasonable person says, yes, I would have seen this as money laundering, then they can prove that you were negligent, ignorant. You should have known. It was reasonably expected of you to know. And you will be held liable for money laundering. Very important. What is the penalties? This is all in terms of POCA. The penalty for committing a money laundering offense, fines up to 1 billion rand, quite high, or life imprisonment. Not a situation you want to be in. So now that we know what money laundering is and what is the offense and the definition, what is FICA and why is it necessary? So what happened was we have this very nice act that says it's illegal to commit money laundering. The problem with it was enforcement. We don't have the manpower within the police, within the enforcement agencies to enforce this act. So they said, okay, let's get everybody else to help out. Let's make it a responsibility for all businesses to tell us when they suspect a money laundering transaction. And then at least we have eyes everywhere. We have a lot of people who can help us. That's the point of FICA. Now in terms of FICA, they did say, okay, but not every business have the same risk of being used for money laundering. So let's split it up into three categories. We have general businesses, who is all the low-risk businesses. They do not really have a risk for being used for money laundering. Then you have your accountable institutions, and those are your real high-risk entities, which will definitely be used for money laundering. And then you have your reportable institutions. And there's specific lists for your accountable and reportable institutions, whereas the rest are all then general businesses. So let's quickly see who's on this list. For accountable institutions, you have attorneys, estate agents, banks, long-term insurance business, businesses dealing in foreign exchange, financial service provider, investment managers. It's not on here, but your gambling institutions. There's actually 16 specific types of institutions on that list. For reportable institutions, you have 2 on the list: dealers in motor vehicles and dealers in career rands. Now, when it came to dealers in motor vehicles, a lot of people were confused about when are they seen as a dealer in motor vehicle and when will they need to be included. So they gave out some guidance this year just to give a bit more explanation. So a dealer in motor vehicles includes motor vehicle related services provided by that dealer and the buying and selling of motor vehicle parts. Also, they gave a definition of what is a vehicle. It's any self-propelled vehicle, including a vehicle having pedals and an engine, or an electric motor as part thereof, and which is designed to be propelled by these means on land. So very important, propelled on land. And then they specifically include a trailer and a caravan. So if you're only selling trailers or caravans, you are a reportable institution. Then you have your dealers in career rands. Bit of guidance there. Any person who, as a regular feature of his or her business, deals in jewelry, ornaments, watches, or other objects that contain career rands will also be seen as a career rand dealer. So if you are a jeweler and you sell a necklace with a career rand embedded in it, then you will be seen as a career rand dealer as well. Why the difference between the three? Well, as we said, the accountable and reportable institutions have more risk for being used for money laundering, and as such, their responsibilities in terms of the Act is also more. Whereas your general businesses only have one responsibility that they need to comply with. We will look at the responsibilities in a moment. Then you have supervisory bodies, and supervisory bodies mostly for your accountable institutions. The FIC then delegates their powers over to the supervisory bodies, and the supervisory bodies then have to inspect their members and make sure that they comply with the FIC Center. Who are the supervisory bodies? For your financial services providers, it's a financial services board. For your banks and deposit-taking institutions, it's a South African Reserve Bank. For your estate agents, it's a State Agency Affairs Board. For your gambling institutions, it's the National Gambling Board. And for your attorneys, it's your law societies. Please note that you will see IRBA on that list, the Independent Regulatory Board for Auditors. Auditors in their own capacity as an auditor is not an accountable institution. You will not find them on that list. So unless they are registered for providing financial services, they will not be seen as accountable institutions. However, the IRBA has been also given some powers from the FIC Center to inspect auditors and make sure they comply. So what are the duties then of businesses in terms of the FIC Act? The very first duty is the reporting duty of suspicious transactions. And this reporting duty applies to all businesses, whether you are a general, whether you are an accountable, or whether you are a reportable institution. What it basically says is any person within that company, any person who carries on a business, who is in charge of a business, manages a business, or is employed by a business. So really with that last sentence, is employed by a business, the Act covers everyone. Because if you work for a company, you are employed by them, you have to report. You have to report a suspicious transaction directly to the FIC Center. What is a suspicious transaction? Well, it's if the business is about to receive proceeds from unlawful activities or have already received proceeds from unlawful activities. So if you know that you are going to get paid, your client is going to pay you with money that he received from an illegal activity, then you have to report. Or if you are a party to a transaction or series of transactions that constitutes money laundering. You have entered into an agreement with a client or with a supplier or with anyone else that constitutes money laundering. However, only if you are a party to that transaction. So if you find out that your neighbor's business is committing money laundering, you have no responsibility in terms of the FIC Center to report it, because it has nothing to do with you, only if it's in your own business. And this responsibility for anyone in that company, whether it's the receptionist, whether it's the director, whether it's the accountant, if you find out, you shall report in your own individual capacity. However, for accountable institutions and accountable institutions only, they have what is called a compliance officer. And the compliance officer's responsibility is to help employees to make this report. So the practice in an accountable institution is that as an employee, you do not report directly to the FIC Center, you go and report to your compliance officer. And your compliance officer will then make this report. Our second reporting responsibility is reporting cash transactions above a prescribed limit. This is only applicable to accountable institutions and reportable institutions. General businesses only have to report suspicious transactions. That's where their responsibility ends. They do not need to worry about the rest of the Act. So if you are not on those two lists, you don't need to worry about the rest of the Act. You should report cash, cold hard cash transactions. That's more than 24,999. So equal to 25,000 or more. You shall report this within 2 days that you became aware of receiving that cash. You shall also consider a 24-hour aggregation period. What does that mean? If your client is coming with 5,000 Rand now to pay you, 5,000 Rand in 2 hours, 5,000 Rand in another 2 hours, you have to count all of that up and make sure it's not more than 25. If it is, you shall report it. What is included in cash? Domestic and foreign notes and coins, and it includes traveler's checks. And then they gave a guidance note, a quick example. If you are, let's say, a motor vehicle dealer and you do not accept the cash, you tell your client to take the cash to the bank and deposit it directly into your bank account, which means you receive the cash through an agent, the bank in this case being the agent. The bank will have to report that cash since the bank is an accountable institution, but you will also have to report it on your side. The moment you get your bank statements, you check your bank statements and you realize that you have received a cash deposit, then you shall also report. If you fail to make this report, if you do not make this report, and within your institution, any other person or the director or someone becomes aware of that reporting failure, what should then happen? Number one, you have to go and tell the center. You have to go to the center and say, listen, we did have this money laundering transaction, The person who worked with it failed to report it. Here we are now. We would like to report it. And then that person or the institution have to get into an agreement with the center to mitigate any loss of intelligence data. So they have to request an engagement with the center to discuss relevant mitigating factors. They have to give information to the center as is needed, have to make sure that the center isn't in a worse position as they would have been if you didn't fail to report. So you have to take certain steps. However, the fact that you did take these steps now, the subsequent arrangement that you make with the intelligence center, does not imply condonation of the failure. It also does not absolve the reporter from its continuing reporting obligations or prevent any enforcement action being taken by the supervisory body. So it might well happen that a fine will still be levied, depending on how they feel that day. However, it is necessary that when you realize that there was a failure to report, that you go to the center immediately and report it. Then in terms of making a report, if you have any confidentiality agreements with your clients, please note that this will not impact the fact that you need to make a report. So your responsibility to make a report will not be diminished because you have a confidentiality clause or a confidentiality agreement. That confidentiality agreement is scrapped basically by the FIC Act. The FIC Act supersedes it. You are exonerated from any liability for breach of secrecy. You have to make the report. The only time that client-attorney confidentiality will count is where you are the attorney of a client who is already being sued in a criminal defense context. He's already going to court for money laundering. In that situation, you will then be exempt because now you can't go and report your client. It kind of defeats the purpose. Even criminals have the right of defense. If you do make a report, the rule of thumb is keep quiet about it. The Act does say that any person who has made or must make a report may not disclose that fact or any information regarding the contents of the report to any other person. That means your mom, your dad, your cat, your dog. You can tell no one about the fact that you made the report or about what is in the report. If you do tell someone else, the reason why this section is in is because they want to avoid tipping off the client or the other party, and that other party might then run away and cannot be fined for a prosecution or whatever the fact may be. If you do not comply with this, if you tell your client, or if you do anything that tips off the client, and in the end they cannot prosecute the client, it is seen as a criminal offense, and you can be fined 100 million rand or 15 years in prison. Quite high. You do not want to be in this position. You have some protection if you do make a report. No one can take any criminal or civil action against you, even if the suspicion was incorrect, even if your report was incorrect, if you made it in good faith. If you did it because you had to, because you have a responsibility. If you only made that report because you didn't like your clients and they didn't pay your money, then of course it wasn't in good faith, then they can take action against you. Also, you're not compellable to give evidence in criminal proceedings. They cannot force you to give evidence and to testify, and they have to keep your identity anonymous. They cannot make your identity admissible as evidence. Unless, of course, you testify, then you make your identity known yourself. So that's just all the regulations regarding the reporting responsibilities in terms of suspicious transactions and cash transactions. Then for accountable institutions specifically, have some extra duties. They have extra responsibilities that they have to comply with because they are high risk. The very first there is to register with the FIC Center. To go to the FIC Center and say, here I am an accountable institution, register me. Reportable institutions, please make a note of that, also need to register. The second responsibility there, they need to identify their clients and perform due diligence on their clients to ensure they're not working with terrorists, to ensure they're not working with criminals who will launder money through them. They then need to keep records of their business relationships and transactions. So they need to keep records of all their transactions, all their relationships. They need to formulate and implement internal rules setting out exactly how are they going to comply with the FIC Act, how are they going to ensure that they identify their clients, that they keep the records they need to keep, that they report when they need to report, that they do everything to comply with the Act. Then they shall train their employees on the Act and on their internal rules. So they need to train all employees who are dealing with clients to say, listen, this is the Act, this is the internal rules, this is how we comply with the FIC Act. And lastly, they need to appoint a compliance officer. Now, this is where most of the changes will come in with the new FICA bill. So the biggest changes really there is that they're going to make the customer due diligence a risk-based approach. So you will no longer just follow all the provisions of the Act mindlessly for every single product and for every single transaction. You will have to do a risk-based. You will have to go and sit as an accountable institution and say, but listen, what is my high-risk products where people actually commit money laundering, or there's a risk that people can commit money laundering? And what is my low-risk products? And for my high-risk products, I will then do more work. Whereas for my low-risk products, I can do less. Some of the other changes, they included the fact that you have to record the purpose and nature of a relationship. We have some ongoing due diligence included that we will look at. They included, or they're going to include the persons in prominent positions. They included the beneficial ownership. You have to identify the beneficial ownership of your clients. They want to implement the UN Security Council resolutions, and they want to enhance certain administrative and enforcement mechanisms. We'll look at all of this in detail, but this is the changes that's going to be brought about by the FICA bill. When we look at the risk-based approach, as I said, accountable institutions should identify, assess, and understand their money laundering or terrorist financing risks. They should identify which products poses a higher risk to money laundering, which products poses a lower risk, and then they should develop control measures to prevent those risks. For instance, I'm an attorney, and I know that I have one product, let's say marriage certificates. I set up marriage certificates. It's a low-risk product. No one's going to commit money laundering through it. You pay your 300 Rand and you're on your way, or however much it costs nowadays for the marriage certificate. However, on the other hand, you might have other products where you invest money for people and you distribute money for people and things like that. And that product can be used for money laundering. So you need to know that. And then for your low-risk products, you don't need to implement all the control measures in terms of the Act. However, for your high-risk products, you will have to. So this really aims to make it more simplified for accountable institutions where there are lower risks. They don't need to do all of the requirements that is necessary in terms of the Act. So looking at customer due diligence, what is the requirements? What should be done? Well, the very first thing is to determine the customer's identity. How do you do that? well, for that, there's a nice regulation out on that and some guidance from the Fix Center. For natural persons, you need to get their ID, you need to get their proof of residence, and you need to get their tax number in certain cases. For partnerships, there's specific information you need to get. For companies, there's specific information. So determine their identity. Get all the details in terms of that regulation to ensure you know the client, you know whom you are dealing with. Secondly, you need to identify the beneficial owner. What does that mean? Beneficial owner? Well, if you're looking at a company, if your client is a company, you have to identify who's the natural person, the actual individual who in the end owns that company, who in the end is the beneficial owner. Why? Because terrorists and criminals hide within companies. They don't come and knock on your door and say, I'm a criminal, can I do business with you and use you for money laundering? No, no, no. They hide in their business. So it's important to find out who actually owns and controls this business to know who you are dealing with. That's the new part that came in with the bill. Then you understand the purpose and intended nature of the business relationship. Why does this person want to go into a business relationship with me? And conduct ongoing due diligence. We will look at that in a moment. It also requires accountable institutions to record the purpose and intended nature of the business relationship. That's also new, brought in through the bill. And obtain information on the source of funds for your high-risk clients. So for your high-risk clients and high-risk products, you need to identify their source of funds. If you're dealing with a company, in addition to all the identities and all of those things, you need to understand the nature of the entity's business, the nature of the company, what is its business, the ownership and control structure, who owns it, who controls it, and who is the beneficial owner, the natural person who in the end controls it. So if there's a holding company and another holding company and another holding company, in the end, ultimately, who is the individual, the natural person who owns these companies? Very important that you cannot establish a business relationship or a single transaction with an anonymous client. You need to know who you are dealing with. Then in terms of ongoing due diligence, what does ongoing due diligence mean? Two things. Number one, at regular intervals, confirm that your customer information and risk classification is still correct. Is it still a high risk? Is it still a low risk? In terms of the proof of residence and the details you have, are the details still correct? And secondly, to on a regular basis, scrutinize the transactions you have with this client, scrutinize his portfolio to identify any deviations from expected behaviors, anything that might be weird for this client. Then in terms of customer due diligence, they brought in a new type of person or client, which is called the domestic prominent influential person or foreign prominent public official. For short, a PIP, PIP. And for PIPs, you need to perform extra due diligence procedures. 3 extra procedures. Number 1, obtain senior management's approval for this business relationship. Number 2, make sure you establish the source of wealth and source of funds of the client. And number 3, conduct enhanced ongoing monitoring of the business relationship. So on a more regular basis, check this business relationship. Make sure there's nothing out of the ordinary. You also have to do this for immediate family members and known close associates. What's an immediate family member? It includes a spouse, civil partner, life partner, previous spouse, civil partner, life partner, children, stepchildren, your parents, siblings, step-siblings, and their spouses. Who is seen as PIPs? What is the list? Who's included as PIPs? Any president or deputy president, a minister or deputy minister, the premier of a province, a member of the executive council of a province, an executive mayor, a leader of a political party, a member of a royal family, a constitutional court judge, an ambassador or high commissioner, and an officer of the South African National Defence Force. The list goes on. There's a few extras. The list is in the Act. So what accountable institutions basically will have to do once the bill becomes effective and the Act changes is they need to have this list on file. And for every single client, they will have to ask, listen, are you one of these people? Are you on this list? If the answer is yes, well, then they have to perform the extra due diligence procedures, your 3 extra procedures. Then looking at the obligation to keep records. So all accountable institutions have to keep records, number 1, of the business relationship and of the transaction itself as well. Then they also need to keep records of how they verified the identity of the client. So include copies of the IDs, copies of the proof of residence, any documents that they use to verify the person's identity. For the business relationship, what do you need to record? The nature of the business relationship, the intended purpose of the business relationship, and the source of funds that the client is going to use to fund that business relationship. Where there's a transaction, you have to include the amount of the transactions and details regarding the transactions, but that's a normal type of information that you would need in terms of the Companies Act itself as well. Then as we said, in terms of the bill, they want to implement the UN Security Council resolutions. What does that mean? Well, every now and again, the United Nations Security Council declares a resolution. They send out a sanction to say for a specific identified person or entity, you have to take an action. So they're basically saying these people, these entities, these persons, they are terrorists or they are enemies of the state, or whatever the case may be. We do not want to deal with them. This is the list of people. This is the sanctions you have to implement. And then those sanctions means that no person can directly or indirectly or by any means or any method acquire, collect, use, possess or own property on behalf of those persons or entities in the list, make available any financial service to those entities in the list, or make available economic support to any of those entities in the list. If you find out that you are dealing with these type of people, you have to freeze that property and those transactions immediately. So this is basically what they want to bring in. What's going to happen? The president will send out a notice in the government gazette to say, please note, the UN Security Council has issued a resolution. This is the resolution. This is the people that you cannot deal with. Please make sure you take the action specified in that resolution against those people. And then you shall take those actions, number 1. And number 2, if you realize that you are already dealing with those type of people, you have to freeze the property and freeze the transactions. Then if you realize you are dealing with terrorists or people relating to terrorist activities, or maybe you have property under your control or in your possession on behalf of anyone who committed a terrorist offense, then you also have to report. This reporting responsibility is specifically for accountable institutions. It is not for general and reportable institutions. That is why we discuss it here. So when you do your customer due diligence, as you do your customer due diligence, and you realize, oh, but wait, one of my clients is a terrorist, then in terms of Pok.Tara created this responsibility because Pok.Tara says we're not allowed to deal with terrorists. If you realize that you are, you have to report it to FICA immediately. And you must immediately freeze the assets and the transactions. How do you know you are dealing with a terrorist? Well, once again, the President provides us with a list. And it's the UN Security Council list of people associated with the Al-Qaeda and the Taliban. And every accountable institution should be aware of that list. They should know who's on that list so that they can ensure they do not deal with people on that list. So they can check their clients against the list. And if they find out that they are dealing with anyone on that list, freeze the transaction and report immediately. So then how does the FIC Center make sure that accountable institutions, reportable institutions, and general businesses comply with the Act? Well, they do this through inspections. They appoint inspectors and they send these inspectors to the businesses. An inspector may enter your premises. They can ask for any documents to prove that you are complying with the Act, and they can do a routine inspection. They have the power to do so. However, if they want to enter a private residence, they need a warrant. Please note. They can only enter a private residence with a warrant. They can enter any other residence for the purposes of a general inspection without a warrant. If through the inspection they do find that you do not comply with the Act, they can give you penalties. Now in the past, the penalty was just a flat 100 million rand or 15 years in prison. They changed it now. They split it between non-compliance and offences. A non-compliance is something that is not so bad. And you'll only get an administrative sanction, which can be any amount that they can really think of. Small amounts. Offences, however, you will get your big penalties. For non-compliance, what can happen? What is the administrative sanctions? Well, they can either caution you to let you know, listen, you are not complying with the Act, please comply in future. Or they can reprimand you, or they can ask you for a directive to say, please comply in future, or they can suspend your business activities. So they will start with the easy ones, a slap on the wrist, a caution to say, please note you are not complying. Please note you have to comply in the future, otherwise steps will be taken. If after all the nagging you still do not comply, they then will give you a penalty. And that penalty for a natural person can be anything up to 10 million rand, and for a legal person, anything up to 50 million rand. And please note that supervisory bodies have the power to give this penalty. They can give that 10 million or 50 million rand penalty. If you look at the penalties that were given last year to the banks, that was the category it fell into. Their penalties range from anything between 10 million and 60 million rand. Whereas if you are penalized and you get a penalty, the penalty then is 100 million rand or 15 years in jail. 100 million rand or 15 years in jail. Quite high penalties. That then is FICA and the responsibility to report in terms of FICA and Pok.Tara if you know about any money laundering activity going on. Then if we quickly look at PRECA, PRECA talks about reporting a corrupt transaction to the Hawks, to the police official in the Directorate for Priority Crime, which is the Hawks, and that will be any offense of theft, fraud, extortion, forgery, uttering a forged document of more than 100,000 rand. Only specific people have to comply with this duty. Not everyone have to make that report. So you will, if you look at the list, you will see it's mostly your managers and people in charge of businesses. So a manager, secretary or director of a company, a member of a CC, an executive manager of any bank, any person who is responsible for the overall management and control of a business, CEO, the Director General, a municipal manager, a public officer, any head, rector or principal of a tertiary institution, and any partner in a partnership. If you fail to do so, if you do not make this report, you can go to jail for 2 years. In your private capacity, they will send you to jail for 2 years. Not a situation you want to be in. And then the last week amendment we'll look at is an amendment in terms of POCA, the Prevention of Organized Crime Act. And they inserted a new offense into POCA, and that is now any offense referred to in Section 3 of the Criminal Matters Amendment Act. And it's an offense relating to essential infrastructure. So what that basically means is any person who unlawfully or intentionally tampers with essential infrastructure or colludes with another person or assists another person to destroy or damage essential infrastructure will be liable to a fine of 100 million rand or imprisonment of 30 years. Very high penalties here. If you are found guilty of tampering or damaging essential infrastructure and you knew that that was essential infrastructure. So what is essential infrastructure? It's really not that hard. It's any installation, structure, facility or system. If there's loss or damage to that system, it will interfere with the provision or distribution of a basic service. So essential infrastructure is basically the infrastructure that provides a basic service. What is a basic service? Included in basic service is energy, transport, water, sanitation, and communication. Those 5. So if you're going to tamper with any infrastructure providing any of those 5 basic services, you are committing an offense. If you're going to steal electricity cables, you are committing an offense. If you are going to burn down a bus, you are committing offense. And you will go to jail for 30 years. Lastly, quickly looking at some statistics in terms of FICA. Our registrations for accountable institutions increased from 26,000 to 30,000 in 2015, so we got 4,000 more. 7 million reports were submitted to the FIC Center, of which 6.7 million were cash threshold reports, and about 300,000 were suspicious transaction reports. So the system is definitely working. People are making use of this. People are reporting as they should, which is a good thing. The act is being complied with. From these reported transactions, they could forfeit and confiscate assets to the value of 2.3 billion rand. 2.3 billion, quite high. And that of course goes into the government fund. In terms of inspections, the supervisory bodies and FIC conducted around 740 inspections. And from those inspections and penalties, 140 million rand in financial sanctions were imposed in penalties, mostly to the banks. And lastly, just a bit of interesting reading material. Investigation requests received by the FIC Center. For money laundering, they received 746 requests from, of course, other enforcement agencies, the police, the Hawks, SARS, whomever. For corruption, 515. For fraud, 470. Narcotics, 242. tax-related 146, and so on and so forth. What is interesting about this results and these statistics is that we can see the Act is working. People are making the reports. It's helping with criminal investigations. Things are happening. So an Act that we need to adhere to. The next Act we're going to look at is the National Credit Act. And what we're really going to look at here, we're not going to look at the whole Act. We're really just going to look at some sections, specifically where the amendments came in. We're going to look at the amendments made by the National Credit Amendments Act in March 2015. And we're also going to focus on the new affordability assessment that came in March 2015. You will see that most of the changes that we're going to look at for the National Credit Act all came about in 2015. There were two big changes that came about this year. However, we are still going to look at all of those changes just to make sure everybody is up to date. So we start by looking at the scope of the Act. Who does it apply to? Who is credit providers that should worry about this Act? And what is credit agreements that is governed by this Act? Credit providers includes anyone like banks, any micro lenders, your small loans below 8,000 Rand, short-term loans, any retailers such as clothing and furniture stores, all businesses, companies, closed corporations and individuals who do business on credit, provide loans or charge interest on overdue accounts. Whether or not you need to be registered, if you provide credit, provide loans or charge interest on overdue accounts, this Act applies to you and you need to comply with this Act. What is a credit agreement that is covered by this Act? Any mortgage bond, credit facilities like a store card, a bank overdraft, a credit card, a garage card, a personal loan, installment sales, leases, pawn and discount transactions, any developmental credit, any incidental credit, and any credit guarantees, specifically included in this Act as credit agreements. Then the Act looks specifically at incidental credit agreements. What is an incidental credit agreement and why are we worried about this? Now, only specific portions of the Act is applicable to incidental credit agreements and not every single part of all parts of the Act. Why is that? Well, to answer that, we need to look at the definition. So credit agreement, you can read there on the slide. In summary, what it basically says is a credit agreement is where you tender goods or services, when you provide goods or services, and your customer doesn't pay you immediately. They have an extended period of time to pay, and if they only pay after a specified date, you're going to charge them interest. So you basically tell them, pay me within 30 days. If you take longer than 30 days, I'm going to charge interest. Or if you pay me within 30 days, you only pay 10 Rand. If you pay after 30 days, you pay 12 Rand. So there's a higher fee applicable if the person pays late. If that is the case, you are an incidental credit provider. And then certain portions of the Act will not apply to you. Yes, you are a credit provider. Yes, you do provide a credit agreement. But number one, you do not need to register as a credit provider. Number two, you do not need to do the affordability assessment. Because can you just imagine if you had to go for every creditor and do an affordability assessment to see whether or not they can afford to buy things from you? You will sit forever. And number three, you do not have to give a pre-agreement statement. Those three things do not apply to incidental credit. I will remind you again when we get to those specific slides. There are some transactions which is specifically excluded from the National Credit Act. And for these specific transactions, credit agreements, It does not fall within the National Credit Act. The National Credit Act does not apply. Number one, where the consumer, the person receiving the credit, is a juristic person whose asset value is more than, or turnover is more than 1 million rand. So you're basically a large juristic person and you receive the credit. Then your specific credit agreement will not be covered by this act and you won't be able to get all the protection in terms of this act. Then a small business. Why do we say small business? The act says a juristic person with an asset value or turnover below 1 million. So if your asset value or turnover is more than 1 million, every single credit transaction that you enter into as consumer is excluded. If your asset value or turnover is below 1 million, you are seen as a small business. And if you then enter into a large agreement as the consumer, it is also excluded from this act. The third one, where the person providing the credit and the person receiving the credit is related. So you borrow money from your mom or your dad. Be careful, however, that it does not include employees. The employee-employer relationship is not seen as a related party relationship in terms of the National Credit Act. So if you provide loans to your employees, it is still seen as a credit agreement. You still need to apply with all the provisions of this act. The fourth one there, where a member of a stokvel borrows money from the stokvel, where a director of a company lends money to his company, and lastly, where a government institution borrows money from any source. So bank borrows money from the South African Reserve Bank. In terms of the types of agreement, you get 3 different types of credit agreements and they split it up for various reasons, one of those being the penalties when you cancel the credit agreement. So if you cancel a small credit agreement, they cannot charge you any penalties. However, when you cancel a large credit agreement, they can charge you 2 months of rent as penalty. What is a small agreement? Any pawn transaction? Any transaction up to 15,000 rand, but excluding a mortgage. A mortgage will always be a large transaction, no matter the value, no matter the amount. Intermediate, anything between 15,000 and 250,000 rand, excluding your pawn, which will always be small, and your mortgage, which will always be large. And then a large transaction, anything more than 250,000 rand or a mortgage. Now the one big change that came through this year deals with the registration requirements. The old act said that any credit provider with 100 credit agreements or a total principal debt of 500,000 rand had to be registered as credit providers. The Amendments Act that came in 2015 removed both of those requirements. And the Amendments Act said that any credit provider that provides credit agreements above the threshold will have to register. And then this year, 11th of May, they set that threshold to 0 rand. What does that mean? That means that any person who now grants credit within the ambit of this act, that grants a credit agreement that in terms of this act must apply to be a registered credit provider. So irrespective of the amount of the loan, irrespective of how many loans you have to register. What's the effect of this? Any person providing more than one loan bearing interest at commercial rates must register as a credit provider. So at least if you only provide one, you're still safe. If you do not charge interest, you're still safe. Otherwise, you have to register. How do you register? You apply with the National Credit Regulator, give them your SIPC documents, give them your auditor's details, give them all the details they need, and then you have to pay an application fee of 550 rand. You have to pay an initial registration fee. The registration fee and the renewal fees per year is based on your amount of your loans. it can get quite high. You have to pay a branch fee for any branches, and of course the annual renewal fee. If you do not pay the renewal fee, there might be fines, and in the end they might deregister you. And if they do deregister you, every single credit agreement that you make after that is illegal. What happens if you make an illegal credit agreement? If they find out about you, you will have to pay that money back. You will not be able to get your money back from the consumer unless you take them to court for unfair enrichment. That's the only way you will get your money back, because it was illegal to give them the money in the first place. What's the impact of this on employers, where you might provide loans to your employees? If you give an advance, an interest-free salary advance, that must be repaid within a specified period of time. So you tell your employee now, here's 500 Rand, at the end of the month it's coming off of your salary. Then it's not a credit agreement, because you do not charge interest. It falls outside the ambit of the Act. If, however, you're going to provide a loan where they have a maximum amount of time to pay off the loan, and you charge interest, whether that interest is charged at a commercial rate or a nominal rate, the fact that you charge interest 1%, 2%, 5%, 30%, the fact that you charge interest makes that loan carry some level of commercial significance. And because of that, they deem that transaction to be concluded at arm's length, and you will have to register as a credit provider. If you do not, then those loans are illegal and you will be in trouble. You will have to pay that money back. If you provide share schemes where interest-bearing loans are made available to employees to buy shares, it is also seen as a credit agreement, regardless of the intention and purpose of the transaction. Please note, the only thing that changed now is the registration. You have to register. Nothing else changed. In the past, you still had to comply with this whole Act. You still had to make sure you do not give reckless credit. You still have to do all the other things as per this Act. It's not now suddenly the Act applies. The Act always applied. It's only the registration part that applies extra now. Okay, now that we know that the new thing is everybody should register, let's look at the rest of the Act. What is unlawful agreements? And one, as we said, if you make an unlawful agreement, then you will have to pay that money back. Well, you'll have to pay back all the interest you charge, and you won't be able to get your capital back out of the consumer. Any agreements with minors, anyone below 18 years of age, anyone who's mentally unfit, because a mentally unfit person can't reasonably be expected to understand his responsibilities in terms of that credit agreement. Anyone who's under administration, who already cannot pay his current debt. Negative option marketing is illegal. What is negative option marketing? It is where they send you, Foschini sends you a credit card, or a store card, sorry, and they say, you're so nice, you're so wonderful, here's a store card, come buy on credit. And if you don't go back to Foschini and cut that store card up in front of them, they assume you want it. You didn't say no, so they assume it is a yes. And then they open the account for you and they start charging monthly fees and service fees and yearly fees, and then they send you these nice books to show you what clothes they have, and they charge you for that as well, and then they charge interest on it, and 2 years later you suddenly get a big bill of 2,000 Rand and you didn't buy any clothes. That's negative option marketing. It is illegal. You have to say yes before they can open an account for you. You have to actively respond. Otherwise, they have to assume it's a no. And then lastly, unregistered providers. Unregistered providers that should be registered, and with the new changes, that is everyone. What happens if you are caught with an unlawful agreement? The credit agreement is void. As provider, you have to refund all the interest you received and all the payments you received. You cannot take, well, the old act said the money was forfeited to the state. You couldn't take any action to try and get it back. They have, however, declared that unconstitutional. So you can take the consumer to court for unfair enrichment and try to get your money back that way. However, to you, I say good luck in doing that. So rather try not to be in a situation where you provide an unlawful credit agreement. The second thing we need to understand is reckless credit. What is reckless credit? And the big difference really between illegal credit and reckless credit is that illegal credit is immediately void, immediately. Whereas reckless credit will only become a problem where the consumer goes into debt review and he is declared over indebted. That's the only time reckless credit will become an issue. If that person is never over indebted, then you'll get your money. Then you don't have a problem. What is reckless credit? That is where you gave credit without going through the correct steps to ensure that this person can actually afford the credit. So you didn't take the reasonable steps to assess that the consumer understood his obligations, that he had to pay monthly, that he had to pay 20% interest. You didn't assess this person's debt repayment history under his current credit agreements. Go and pull his credit report, credit record and make sure that he's actually paying. You didn't check his existing financial means. And if they borrowed the money for a commercial purpose, you didn't conclude on a reasonable basis whether or not that commercial purpose will be viable, whether or not he will be able to pay back the money. So if you didn't take those steps, you didn't do an affordability assessment, you didn't do a credit check, you didn't get his pay slips and his bank statements, you just said, come to me and get money. It is reckless. You didn't follow the right procedure, it is reckless. On the other hand, if you did follow all the steps, you did explain to him his risks and obligations, you did check his credit history, you looked at everything, and you realized that this person cannot afford the credit. If he enters into this credit transaction, he will be over indebted. He won't be able to pay it. But you felt sorry. You said, oh shame, I feel sorry for you. And you still gave him that credit. It is reckless. If he then goes to a debt review, into debt counseling, and they look at your credit agreement and they say it is reckless, they can then put your credit agreement aside for as long as is necessary for this person to get out of his credit. You might not see your money anytime soon. Worst case scenario, they can declare your credit agreement void and you will never see your money again. You do not want to be in that situation. There was already a case study where that happened, where an old couple borrowed money from the bank to start a little farm, and then the bank didn't do the process right. In the end, the couple was over indebted, and they said that the bank's mortgage over the farm was reckless credit, and the couple didn't have to pay back, I think it was about 1.7 million rand. Quite a lot. You do not want to be in that situation. There is some new requirements regarding reckless credit that came in with the Amendment Act last year. When you go to a debt counselor, if you think you're over indebted and you go to a debt counselor, they are now bound by the Act to investigate any reckless credit. So they have to take, the first thing they have to do is take all your credit agreements, check which one they think was reckless, and give that over to the National Consumer Tribunal to make a finding. In the past, only the court could declare a credit agreement reckless. Now, the National Consumer Tribunal can do so. So that will make it quicker, more swifter action, and the consumers can get relief quicker. If, however, you did do that whole assessment, you found that yes, this person can, for the credit agreement, he can afford it, and you go into this agreement, you have to give what is called a pre-agreement statement. It's a nice invoice or agreement or note, whatever you would like to call it, that sets out for the client exactly what he is getting himself into. How much would he be paying per month? What is the interest per month? What is the initiation fee? What is the insurance, if there is any insurance? What is the service fees? What is the principal debt? And then very important, a new thing that should be included on that agreement, the credit cost multiple. The credit cost multiple is the ratio of the total cost of credit to the principal debt. So if I borrowed 100,000 Rand, I'm paying it off over 5 years. In the end, I'm paying 100,000 Rand in interest as well. They have to indicate it on this pre-agreement statement to say, my ratio is 1 to 1 or 0.9 to 1 or whatever the case may be. So you need to show that to the client. You need to bring his attention to that, and you need to ensure that he understands it. The second change that came about this year is in terms of the maximum fees and interest rates that can be charged for your credit agreements. That came in on the 6th of May 2016. The maximum interest rate is based on the repo rate, which is currently 7%. So please note the percentages there on the slide isn't fixed. It is based on the repo rate. So home loans is 12% plus repo rate, which gives you 19%. Credit cards, 14 plus repo rate, which gives you 21. Unsecured credit transactions, 21 plus repo, which gives you 28. And incidental credit is 2% per month. I do apologize. Please just correct it on the slide. The slide still says per year. It is 2% per month. For micro lenders, the maximum credit amount for micro credit agreements is 5% per month, which gives you 60% per year, quite high. 5% per month for the first credit agreement and 3% for subsequent credit agreements. So incidental credit, 2% per month, which gives you 24% per year. Maximum initiation fees for a home loan, 5,250 Rand. For credit cards and store cards, 1,050 Rand. And for unsecured credit transactions, short-term credit transactions, and other credit agreements, 1,000 Rand 50. Then with regards to interests and all of these service fees and so on, we have a rule in the Act called the in duplum rule. And in duplum basically means double the amount. And what the in duplum rule says, well, there's two different ones. You have the common law rule, the common law in duplum rule, which is for all other acts, which came about through common law. And it says that interest on a debt will cease to run where the total amount of arrear interest has accrued to an amount equal to the outstanding principal debt. What that means is the moment I owe you 2,000 Rand, if I am in default, this rule will only apply when you are in default. When I am in default, I'm not paying you, and interest accrue. And interest runs up to 2,000 Rand, equal amount to the outstanding debt. Then you are not allowed to charge me any more interest. If I then pay you, let's say 500 Rand, then you can charge interest again up until 2,000. You can just see the problem with that, however. It's that if you fall into this situation where you cannot fund your debt, and you try and pay something off, you come and you try and you pay 5 Rand, 10 Rand, 50 Rand, 500 Rand, interest will just start accruing again, and you'll be stuck in that forever, unless you suddenly have the full amount to pay off. So they changed the statutory in duplum rule. the induplum rule that's written into the National Credit Act in section 103 says not only interest, but all amounts, initiation fee, service fee, interest, insurance, default administration charges, and collection costs. All of these amounts together, if they accrue up until the same amount as the outstanding debt, you cannot charge me anything else. No more initiation fees, no more service fees, no more collection costs, no more interest. You have to stop charging me. In total, I can then only owe you 4,000 Rand. And if I start paying you back, you cannot start raising interest again. So if I only pay you back 500 Rand, you cannot now start charging interest. The only time you can start charging interest is if I am no longer in default. I have paid up all of my arrear interest and I've started paying back capital. I'm no longer in default. Only then can you start to charge interest again. So that really helps in terms of being stuck in that circle where you can never get out of debt. Please note, however, that the induplum rule does not apply to SARS, unfortunately. SARS can charge you as much interest as they want. In terms of credit insurance, a credit provider is allowed to require credit life insurance. He may ask you to take out insurance over the amount that you are borrowing. However, there are a few rules. Number one, they cannot force you to take the insurance with them. You have your pick. You can choose whomever you want out there. And if they use this as a reason to not give you the credit, please note in terms of the Act. Number one, you have the right to ask why they do not want to give you the credit. Number two, if this is their reason, it is unfair discrimination. It is illegal. You can report them. If you do take the insurance with them, there's a few rules. It cannot exceed the outstanding obligation. They cannot ask you to take insurance for an amount more than that which you borrowed. As you pay off your loan, they should reduce the cover on the outstanding balance because you owe them less, so you should be insured for less. If it's a home loan, the amount may not exceed the value of the property. And lastly, premiums may not be capitalized upfront. This is really some unscrupulous dealing that the companies are doing. They capitalize all of the premiums, the 12 months or the 36-month premiums upfront, and they charge interest on it. It is not allowed. If you then have customers who are in default, they are not paying back the money, you can take debt enforcement steps. However, there is a large number of illegal credit providers who impose illegal debt enforcement. They still retain your ID, your debit or credit card, your PIN number, your SASSA cards, and this is not allowed. It is illegal. What should you do? You should notify in writing. You should notify the consumer in writing. It's called the Section 129 letter that you have to send by registered post and let them know that they are in default and they need to pay their money. Then they have some options. They can either go to a debt counselor or they can contact you within 10 days to arrange for alternative payment. In terms of the Section 129 notice, please note in and of itself it is not legal action. It's really just a notice to say if you are not going to pay me, I am going to take legal action. You cannot take legal action if you did not send this notice. And you have to send it by registered mail. Very important. If you want to take debt enforcement steps in terms of submitting information to a credit bureau, giving this person up as a bad payer, please note you cannot do this in certain instances. Number one, you cannot do it for a debt that has prescribed. A debt that is older than 3 years and you didn't do anything to recover that money. You can also not do it if the person is not behind for at least 3 months. Needs to be behind for a minimum of 3 months. You should give the 129 notice first. You cannot give them over to the credit bureau without giving that notice. And if they do settle the outstanding amount, if you give them the notice and within 10 days they settle the amount, you cannot give them over to the credit bureau. So you have to wait for them to be outstanding for 3 months. Then you have to give the notice, and then you have to give them 10 days to pay that amount or to come and make alternative agreement before you give them over to the credit bureau. If you do give them over to the credit bureau, if they are outstanding for 3 months, you send them the notice, they don't do anything, they don't come and pay, and you give the data over to the credit bureau. Please note, the moment they settle that amount, the moment they pay the amount, you then have to advise the credit bureaus and they have to remove that adverse information. Then another 2 new things that came in through the Amendment Act. A consumer's credit record can no longer be accessed by an employer, an employment agency, a recruitment consultant, a staffing company, unless they can certify that the reason for that is because you are applying for a position requiring honesty. You're going to deal with cash or finances or anything like that, and they need to make sure that you can sort out your own finances before you come and sort out the business's finances. In terms of credit provider who has to submit information to the credit bureaus of late payers and things like that, it must be in the manner and form prescribed by the National Credit Regulator. Then we have a new thing coming in through the Child Maintenance Bill, which I think a lot of people is quite excited about. If you are a parent who is defaulting on your child maintenance, they will now put that on your credit record. Your details will be handed over to the credit bureau and you will be prevented from accessing any more credit. You won't be able to make any more credit. If they cannot trace you to get the money out of you, they will then, of course, we have now RECA, very nice. They can go to the cell phone service providers and a court will be able to give an order to say, service provider, please give the contact details to the court so we can find them. So waiting for that to become effective. But what now if you really cannot pay your debt? You got the Section 129 notice, you are 3 months behind, the information is going to the credit bureau, you really cannot pay your debt. What now? Well, then you can go for debt counseling. What is debt counseling? It's a process intended to help restructure your debt obligations in such a way that you pay a bit less, that you can make all your payments, that you get to everything. So what you will do is you'll go to debt counselor. We said the first thing they have to do is look what is reckless credit. Find the reckless credit agreements. They will put that aside. They will set it aside. Then they will take all of the rest of your agreements, figure out something. Maybe they can bring the interest down. Maybe they can make the period longer and make a proposal to your credit providers to say, let's do this. While you are in that review period, the credit providers cannot take any action against you. They cannot do anything. So be aware, if you're thinking of applying for debt counseling, please note sometimes the bank freezes your account if you have any credit with them that's going into this debt review for some or other reason, maybe just to see if they can get more out of you. So I know they do that because they realize now they can't take any legal action against you. While you are in that debt review process, you're also not allowed to take any other credit. And if you fail to make a payment in terms of your agreement, then the creditors can take legal action against you. So if you have an agreement, you fail to make a payment in terms of your agreement, then they can take action against you. Once you have settled all your debt, the debt counselor will give you a clearance certificate to say, okay, you are clean, you can go and make some more debt. See you in 3 years and we'll start the process all over again. And then very, very important, they said now, a debt counselor must never ever collect and distribute money on behalf of their customers. Because we had a lot of debt counselors, fly-by-nighters, who came in, took people's money and disappeared. Not a good thing. They can no longer collect and distribute money. In terms of the clearance certificate, problem with the clearance certificate is that if they consolidate your debt into a mortgage, it's going to take about 15 to 20 years for you to get that clearance certificate. You're going to sit for 20 years, you won't be able to make any debt. So they change it now to say you can get the clearance certificate if all your short-term debt is paid up and the only thing outstanding is a mortgage. In terms of the payments, we said a debt counselor can no longer receive payments on behalf of the credit providers and then paid over to them. So a new type of business popped up, came into being, a payment distribution agent. And the payment distribution agent will now be the person, the middleman, that takes the money from the consumer and pays it over to the credit providers. However, if you go into debt review, you are not obliged to use a PDA. It's a choice that you make. You can still pay the credit providers yourself. However, there are very, very stringent controls over the PDAs because once again they want to avoid a situation where the PDAs now run away with the consumer's money. So PDAs needs to be registered. They must apply to the National Credit Regulator. They must show they have education, experience and competency. And no credit provider may have an interest in a PDA. A PDA must also maintain a fidelity insurance and trust account and submit financials to the National Credit Regulator for purposes of auditing. So very heavily regulated. The last change that came in with the National Credit Act is in terms of the affordability assessment. And why did they change this? They brought in the affordability assessment because they said all of the credit providers have their own way of identifying whether or not the consumers can pay for the credit. And some of those assessments are not good enough. And it led to increased reckless credit, which we do not want. So they want to standardize the affordability assessments. They want to make it the same across the board for everyone. The affordability assessment is based on discretionary income. Discretionary income means gross income, less your statutory deductions such as your tax, UIF, maintenance payments, then less your necessary expenses, which we calculate per a table. We will look at the table now. Less all your other committed payment obligations, such as your evidence from your credit records, and they can see mostly everything on your credit records. Then they get to your discretionary income. And based on the discretionary income, they then decide whether or not you can afford the credit or not. Here's the table where they calculate the expenses, the necessary expenses. And you then work with bands. If you pay between 0 and 800 Rand per month, your monthly fixed factor is 0 Rand. Your minimum monthly fixed factor is 0 Rand. And your percentage is 100% of your salary above the minimum band, which means that your necessary expense is 100%. It's everything. You don't have anything left to take out credit with. If you receive between 800 and 600, the fixed factor is 800 Rand, and the percentage extra over and above that, 6.75% of your salary. For 6,000 to 25,000, the fixed amount, 1,100 Rand, and 9% plus 9% of your salary, so on and so forth. And in that way, they then calculate a necessary expense to deduct to get to your discretionary income. However, what about lower expenses? You have these people who still live with mom and dad. They don't have any housing expenses, they don't have any food expenses, they really don't have any expenses. What about those type of people? Well, in those exceptional circumstances, you will be allowed to use the lower declared expenses. However, the customer has to complete a questionnaire. They have to include proof that their living expenses is less. They have to provide reasons why, and you need to be happy with this before you use it. Over and above the normal affordability assessment, a credit provider must also take steps to assess the consumer to ensure that the discretionary income that you calculated is actually correct. So you need to look at things like pay slips, bank statements, other similar credible confirmations, calling the employer asking if they work there, things like that. And then where the consumer's gross income shows variance, you have to use the average gross income over the period of 3 months. So you cannot just use the last month's income. You have to use an average over 3 months to calculate the discretionary income. Lastly, in terms of the National Credit Act, we quickly look at what is prescribed debt. Debt prescribes if you do not show any knowledge of that debt verbally or in writing for 3 years. You do not ask someone to pay. He does not make a promise to pay. You do not issue any summons. You do not send any Section 129 notice. For all purposes, you forgot about that debt. You wrote it off. Then it prescribes you cannot claim it. It is illegal to claim prescribed debt. Certain debt prescribed after 3 years, your retail accounts, credit card accounts, telecom accounts, cell phone accounts, and then other prescribes over a longer period. A mortgage only prescribes after 30 years. Tax only prescribed after 15 years. Municipality debt only prescribed after 30 years, and a TV license also after 30 years. It is illegal to try and collect a debt that has prescribed or to sell a debt that has prescribed. You cannot do it. Before the Act was changed, prescription was interrupted if a debtor acknowledged the old debt or made any payment towards it. But now, no longer so. Even if that person makes a little payment towards it, if you do not try and take legal action against him, he doesn't promise to pay, he doesn't acknowledge anything like that for 3 years, it prescribes and you cannot recover it. That then gets us to the end of the National Credit Act. The last one we're going to look at before the break is the Consumer Protection Act. We're not going to look at the Act itself, we're specifically going to look at the Consumer Goods and Services Ombudsman. We have to, however, understand the scope of the Consumer Protection Act if we need to understand who the Ombudsman will apply to. So the Consumer Protection Act itself applies to every transaction within the Republic in terms of promotion or supply of goods or services, as well as the goods or services themselves after the transaction is completed. This includes franchise transactions, any transactions by profit business, any non-profit entity, state or entities contracted by the state, and public-private partnerships. So it really includes any business that's going to provide services or products. It applies to a supplier, and then they say, what is a supplier? A supplier is any person who markets goods and services in the ordinary course of business. It includes governments, municipalities, all your businesses. However, it does not apply to private sellers of homes and motor vehicles. So if I'm selling my home or I'm selling a motor vehicle, the CPA does not apply to that. Otherwise, If that person comes back within 6 months and I have to give him a new vehicle, I won't have the finances to do so. Now, one of the central features of the CPA, and this is really what the Ombudsman is built upon, is that the supplier should give honest and truthful information to the consumer so that the consumer can make informed choices. If the supplier gave you all the information necessary to make your choice, you cannot complain. If, however, they didn't, then you will have a leg to stand on, you will have something to complain about. So the Consumer Goods and Services Ombudsman were launched on the 1st of March 2015. They are the official dispute resolution. Then if you have any issues with a supplier, and businesses will have to register with the Ombudsman. If you do complain, they will have 60 business days to resolve your claim to the supplier first. If you go to the Ombudsman first, they will refer you back to the supplier. And you have 3 years to complain. After 3 years, your complaint will prescribe. You cannot do anything about it. So they will listen to any complaint brought to them by a private individual, a juristic person, or a small business whose asset value or annual turnover is below the threshold of 2 million rand. Then you can go and you can complain to the Ombudsman. How can you lodge a complaint? As we said, you should first go to the supplier themselves. Otherwise, the Ombudsman will refer you back to the supplier. If you had no luck with the supplier, they couldn't help you, you can call the Ombudsman, complete your complaint form, and you have 3 years to do this. How will the resolution then work? Well, the first thing they will do is they will call the complainant to clarify the issue, get all the information they need out of the complainant, make sure they understand everything. If they then can resolve the complaint, the supplier will have to provide proof to the Ombudsman that they did resolve the complaint, that they sorted out everything, that the consumer is now happy. Otherwise, they need to do an investigation. So the supplier will most likely do an investigation into why you are unhappy, what's the cause, why did your product break. If they find that it's your own fault and they don't want to replace your product, so they cannot resolve the issue, they have to get back to the Ombudsman and tell them this and give them a reason and show them the investigation results and the fact that they cannot resolve this. So what can you complain about? Quickly see what you can complain about. There's quite a lot. The first thing, delivery defects and exchanges. If the product has a defect or does not do what it is supposed to do in the first 6 months after you bought it, you can complain. If the product you ordered was not delivered in a reasonable time, if the product was delivered but it's not what you ordered or it was damaged, the product was past its sell-by date, a defect in the product caused you harm, injury or illness. For all of this, you can complain if the supplier didn't want to sort it out for you. Unsatisfactory service, you received some type of service and you were not happy with it. Whether it was for education, information, advice, consultation, transportation, any service you received and you were not happy with. You complained, they didn't want to give you your money back, you can go to the Ombudsman. If you want to cancel a reservation or a booking and they do not want to cancel it for you, however, you cannot complain about a cancellation penalty. They are allowed to charge a cancellation penalty. Display price. You can complain if the price on the goods was 20 Rand when you got it till you had to pay 30 Rand and they do not want to fix it for you. Because in terms of the Act, in that instance, you are then allowed to pay 20 Rand. They can't force you to pay 30 Rand. So you can complain. Stock. The item was advertised but there was no stock. You got there and it was all gone. Please note, however, in the advertisements, if they say while stocks last, that's the way they protect themselves. Because otherwise, if you think about it, these big sales, you get there, 10 Rand a Coke, people are fighting over Coke, in 2 hours the Coke is gone. In that instance, it's not their fault that it's sold out. So they do cover themselves by saying while stocks last. Lastly there, shocking, rude or discriminatory treatment. So if someone uses physical force against you, undue influence, pressure, duress or harassment, unfair tactics, anything like that, you can complain. If they discriminated against you on any of the grounds in the Constitution, you can complain. What happens after you complain? What's the consequences if the supplier doesn't want to do anything about it? You complain to the ombudsman goes to the supplier, tell the supplier sort this out, but the supplier does not want to. Please note that if the ombudsman makes a ruling, let's say the ombudsman tells the supplier that, listen, you have to give Yvonne a new coffee machine because her coffee machine broke within 6 months. It's still within the warranty. That ruling is not binding. It cannot be imposed on the businesses. There's no sanctions. There's no penalties. They can refuse to abide by that ruling. However, they have a name and shame policy. Type of the same like Hello Peter. So the moment there's a complaint and the supplier does not want to sort it out, your name will go onto a list and everybody will be able to see how many times someone complained about you. And reputationally, that's not a place you want to be in. Because you can imagine if I go onto that list and I see, oh, currently MTN is the highest complained about business, I might not want to go and get a phone contract with MTN. And currently they're number one on that list. So you want to make sure that you have a proper complaints process within your business where customers can come and complain to you without going to the ombudsman first, so that it does not get out to the stage where it goes to the ombudsman. That then is the Ombudsman and the Consumer Protection Act. It is now an hour and 40 minutes into our session. We are going to take a 20-minute break now. So we're going to break for 20 minutes and then we'll be back for the last part of our session. Thank you.